Hello guys, so I don't know about you, but when I started trading, I was completely ignoring the trading volume. I was testing all possible combinations involving different indicators and strategies on all kind of time frames, but I didn't bother to include the volume in my trading decisions. And of course my trading balance was going down every week, and my frustrations increased with every trade I took. Luckily for me, I read some articles about the volume and decided to incorporate it in my trading strategy. You see, there aren't many trading books devoted to the topic of volume analysis, and most trading books or courses cover volume as a secondary topic and don't offer an in-depth discussion. Volume is a critical aspect of technical analysis, so in this video we'll discuss about how you can add volume into your price action trading, and you'll learn how to spot strong trends and how to anticipate reversal areas, taking into account just two variables, the price and the volume. Before you continue, if you are new to this channel and you find value or you learn something new, please consider subscribing and leave us a like to show your support. So, volume is a significant tool because it shows the conviction of buyers and sellers and is one of the simplest methods for observing buying and selling activity at key levels on a chart. By itself, the volume can provide conflicting messages for a specific setup. But when you combine volume with price, things will become much clearer and simpler. So first, let's define the basic principles of price action. I know that the following techniques may sound extremely easy for some of you, but you will be surprised at how often people will forget these simple facts of reading price action. Now, when I analyze a chart, I like to assess the market phases. There are only three ways the market can go: up, down, or sideways. The market is going up when the price is making higher highs and higher lows. The market is going down when the price is making lower highs and lower lows. And the market is going sideways when the price is not making higher highs and higher lows, or lower highs and lower lows. Like I said, very simple and not complicated at all. Now, a trend remains intact until there is a clear sign that the trend has reversed. A reversal in the primary trend is signaled when the market is unable to create another consecutive swing in the direction of the primary trend. So for an uptrend, a reversal would be signaled by an inability to reach a new high, followed by an inability to reach a higher low. In this example, the market has gone from a period of consecutive higher highs and lows to consecutive lower highs and lows, which are the components of a downward trend. The reversal of a downward primary trend, as shown in this example, occurs when the market no longer falls to lower lows and lower highs. This happens when the market establishes a new swing that is higher than the previous swing, followed by a low that is higher than the previous low, which are the components of an upward trend. When the price will start to stall and not make a new swing high or low, and will stay contained within the last swing high and low that was made on the chart, this translates into a trading range. In this chart, you can see that the price was making lower highs and lower lows all the way to the first arrow, which would be the last lowest low. Price then moves higher to make a higher high. At this point on the chart, in real time, the price needs to either start moving higher past the last swing high, making a new high, or move lower past the last swing low, making a new low. Until either of those things happen, the price will most likely remain range-bound. These are the main techniques of determining a trend using price action. But how about increasing our chances by adding volume to the equation? Like I said in the beginning of the video, adding volume to the price action will allow us to be more precise when we enter or exit the market. I've tested most of the volume indicators, and the most efficient for me is the on-balance volume. The on-balance volume relates volume to price change. We'll keep things simple, so all you need to know about the OBV is the fact that it increases or decreases during each day in correlation on whether the price closes higher or lower compared to the close during the previous day. So the main assumption is that the on-balance volume movements precede price changes. As the volume is the main fuel behind the market, the OBV is designed to anticipate when major moves in the market will occur. There are 9 different patterns involving the price action and the OBV, 3 for each market phase: upward, downward, and range. First, let's analyze the patterns during an uptrend. The first pattern is when the price is making higher highs and higher lows, and the OBV direction is upward. This indicates a clear and strong uptrend. When you see this on your charts, it means that the price and volume are aligned and that the buyers are in complete control of the market, as you can observe on this chart. Here's another example. The price is making consecutive higher highs and lows, and the OBV is following the same pattern. The second pattern involves the price making higher highs and higher lows, but the OBV direction is sideways. This translates in a moderate uptrend. So, if in the previous case the price was making consecutive highs and lows and the OBV also increased, this time the OBV runs sideways. This isn't necessarily bad, it means that the market direction is still up, but the strength of the buyers diminished and more sellers entered the market. Here's another example with the market recording consecutive highs and lows and the OBV in sideways mode. The price continued its upward direction, but at a slower pace. The third pattern involves the price making higher highs and higher lows, but the OBV direction is downward. When you see this pattern on your charts, this means that you are in a weak uptrend near reversal. Let's analyze this chart. We can clearly see the price is making higher highs, but the OBV is making lower highs, suggesting a possible reversal of the price. Of course, during strong trends, the price may continue to go higher, but when you see the OBV in divergence with the price action, you should be careful adding long positions. Now let's analyze the patterns during a downtrend. The first pattern is when the price is making lower lows and lower highs and the OBV direction is downward. This indicates a clear and strong downtrend. When you see this on your charts, it means that the price and volume are aligned and that the sellers are controlling the market, as you can see on this chart. Here's another example. The price is making consecutive lower lows and lower highs, and the OBV moves downward. The second pattern involves the price making lower lows and lower highs, but the OBV direction is sideways. This suggests a moderate downtrend. Like in the case of an uptrend, this isn't necessarily the end of the downtrend. It means that the market direction is still down, but the strength of the sellers decreased and more buyers are entering the market. The third pattern involves the price making lower lows and lower highs, but the OBV direction is upward. This means that you are in a weak downtrend near reversal. If you look at this chart, we can clearly see that the price is making lower lows, but the OBV is making higher highs, indicating a possible reversal of the price. So when you see a rising OBV in divergence with a downward price action, you should be careful adding short trades because the buyers are adding more positions on the market. Now let's analyze the pattern during a range. When the price fails to make a new swing high or low, will stay contained within the last swing high and low, and the OBV is increasing, this could be a possible accumulation period. The accumulation phase is basically a stage of consolidation. There is no clear trend, and traders and institutions are slowly accumulating shares, but the market has not made a breakout yet, as in this example. You'll see this kind of price action and volume during a market bottom. when the price fails to make a new swing high or low, will stay contained within the last swing high and low, and the OBV is decreasing, this could translate into a period of distribution. This phase is characterized by some periods of volatility, but primary is a period of consolidation. The control of the market begins to shift from buyers to the sellers as traders and institutions begin to take their profits. You'll see this kind of price action and volume during a market top. The third pattern involves a sideways price action combined with sideways OBV. You should simply not take any trades during this period because this is a period of uncertainty with no clear direction from price or volume. By now, I hope you are convinced by the power of combining price action with volume. Volume is invaluable when confirming trends, and if the volume isn't present alongside price action, then the resulting trading signal isn't as reliable. So, if you learned something new or found value, please consider subscribing to our channel, share and like this video, as it will help us a lot in the future. Until next time.